Important terms of accounting. Capital, it generally refers invested in enterprises by the owners. It is used to refer the interest of the owners or the proprietors. Balance sheet, it is a statement of financial position of an individual enterprises at a given date, liabilities, capital and reserves, and other balance of their respective book values. Book value, it is a amount at which it appears in the books of account or financial statements. Cost, it is the amount of expenditure on or attribute to specified article, product or activity. It is the amount of expenditure incurred on attributable to the specified activity and product. Current assets, these are as cash and other assets that are expected to be converted to cash, goods or rendering services in normal course of business. Current liability, liability including loans, bills payable, deposits and short period. Long term liability, liability which does not fall due for the payment for the short period. Revenue, the gross inflow of cash receivables or other consideration from the sale of goods or enterprise are rendered to them. Expense, it is the cost of relating to the operations of an accounting period or to the revenue earned during the period or the benefits of which extend the period. Net profit, this is the excess of revenue over the expenses during a particular accounting period. Net profit, this is the excess of revenue over the expenses during a particular accounting period. Sundry creditors, this is the amount owned by an enterprise or an accounting or an account of goods purchased or services, contractual obligations. Sundry debtors, they have a person to whom goods have been sold on credit and owe the certain amount to business unit. Working capital, it is these are the funds available to an enterprise to day operations. Transactions, transaction refer to the business activities involving the transaction of money, amount, purchase of goods, payment, expense and receipt of commission and dividend. Purchases, the amount of goods purchased by a business for sale and purchase of goods and commodities. Sales, these are the goods sold by the business. Sales may be credit sales or cash sales. Now the topic is accounting concepts. Accounting concepts are as follows. Number 1, business entity concept. Business entity concept says that business is treated as a unit or entity from apart from its owners, creditors, managers and other. It means business and proprietor are separate. Dual aspect concept is equal to is that everything has a double effect. There is a debit and credit. Liabilities is equal to asset. Capital plus liabilities is equal to asset. Capital is equal to assets minus liabilities. Every transaction has a debit and credit. Going concern concept says that business will run in a long run. That business will never end. Accounting period concept says that we are believing that business will run in a long run, but the calculation of the business has to be done. There are 2 years are to be considered: financial year and calendar year. Financial year is 1st April to 31st March. and calendar year is to 1st January to 31st December. Money measurement concept says that everything has to be measured in the terms of money, in the value of money. Cost concept. Cost concept says accounting is recorded at the price to acquire that is cost. The cost is the basis of all subsequent cost. Periodic matching concept, net income is equal to revenue minus expenses. Verifiable objective evidence cost. This is the concept, means that all accounting transaction should be evidenced and supported by the business documents. Realization concept, a concept which gives the accounting recognition to exchange the transactions such as sale of goods and services. The realization principle holds the revenue should be recognized accompany the gains or losses point of the sale of arms transaction in the earning virtually is complete. Disclosure concept says that the amount of money and information has to be declared in the books of account, and contingent liabilities are to be appeared in a note. Market value of investment is appearing as a note. Maturity concept. Maturity concept says that it is overemphasized. Accounting will unnecessarily minute the detail. Accounting is not able to make an objective distinction between an international matter. Conservative concept, it is a prospective but leave all prospective profit, that is anticipate all losses than profits. Making the provision for doubtful debts, valuing the stock in trade, creating the provision against the fluctuation in the price of investment, charging the small capital items, amortization of intangible assets, showing joint like policy, not providing the discount of creditors. Now, to understand the golden rules of accounting: personal account, debit the receiver, credit the giver. Real account, debit what comes in, credit what goes out. Nominal account, debit all expenses, credit all incomes and gains. Thank you so much. I think you loved the session. Okay, thank you.